Hey, it's the Brian and Kindra Show. Okay, so I'm super excited. We've been talking about what we're going to talk about soon on this show.
Yep.
And we're going to have like this really fun, like I call it a hodgepodge because I don't have real words. But it's going to be fun. Like it's like got a whole bunch of different topics in it. And Nathan is helping me to fine tune those right now. So we were talking about that. And then it reminded me of like a year ago. And we did it wasn't me, it was somebody else, did this fun reel about with Richard. And it was like,
Can realtors have tattoos?
can they?
I don't think so.
And then you just got your first tattoo.
See? Yeah. look at
Notice
that.
I said first.
Yeah, I thought,
Like, very few people really just have one.
right. One had a purpose. And then
All of mine have purposes.
I was looking at all of the tattoos, and the gentleman I went with was like, hey, he flipped open a book. I'll just have that one. Can you put it, I don't know, put it right there. And I was like, there was no thought in that. And you just permanently did that forever.
That
How
really
do you do
freaks
that?
you out,
It
doesn't
does.
it?
I'm like, I can't. If I had to make a decision of something to put on my body the rest of my life again, I don't know what I would do.
Well, I know my next one is the turtle. After the turtle, I had one more, but anyway, I haven't figured exactly how to make that one work yet.
I can't think of anything
But what it really made me think of was that you were just trying to fit in because you said that you, how did you phrase it? I don't know. You're like, well, I fit in now, or so. I don't know what you said. Anyway, we don't know about Julia.
I'm sure
There's a
the
possibility.
world-renowned spy.
You can't say
I
that
can't
on the
say
radio.
that. She is not a spy. Sorry.
You
maybe.
don't know. Oh my gosh. I'm sure that's not true. Anyway, man, I love our Julia. She's cracking me up and I'm missing her.
I mean, is she in the office? No, we don't know where she's at. I went to England. Yeah, right. She's in Yemen
her
or something
accent's
again.
probably fake.
Yeah.
Anyway, I'm missing her. We're helping her do
It's
her
a great
work.
undercover gig. I'm going to go show houses. And she goes and does a thing and comes back. And
She sells though.
oh, well, yeah.
So
that's
see,
true.
I mean, she does a good job. If that part is
They're probably fake.
I'm listening to a book about spies right now.
We could write it. We could let's make a movie.
Oh man, and Julia's a star. That'd be fun. That'd be so fun. Okay, anyway,
We're doing
Julia,
it.
I can't wait till she gets back. I might even email her in a little bit and just ask her about her tattoo. Okay, so today, what are we going to talk about today?
We're talking about mortgages.
Mortgages. Oh,
What is a
nap
mortgage?
time.
What is a mortgage? Do you have a definition?
I have a. Do you want me to read it?
Just read it.
Do you want me to read it verbatim?
Or close.
Define a mortgage. Because I put this in ChatGPT and said all these different words. I don't know what I said. Anyway, it says define a mortgage as a loan from a bank or lender to help buy a home.
Yeah.
I love that.
we did
Okay,
that.
so mortgage. But actually, you and I were talking about this earlier this morning, that there's so much confusion, or it's not confusion, it's just like almost a frustration. I want to start with that conversation that we had first.
Okay.
There's kind of a frustration that it takes so long to buy a house.
Yep.
And it takes longer to buy a house, typically, whenever you are getting a mortgage
Yep.
in order to purchase your home. So can you buy a house with cash?
You can.
You can,
Now,
but not as often does it
I mean,
happen.
now cold hard folding green money back cash.
Yeah, no, not really.
It's very hard for people to take that at a closing company, but I'll take it.
Bring it to me. Okay, but one of the things that I remembered was some years ago, a car. What was the word? I don't want to call him a car salesman because, sometimes it has kind of a negative sound to it. And this is like one of my most trusted financial advisors, if you get right down to it. So he had said, "Man, sometimes it's frustrating because you think about the difference of I can sell you this $80,000." Tahoe, and this was back when you could get a Tahoe for $80,000. I can sell you this brand new $80,000 Tahoe today. You can take it home today. Like I can get you the loan today. You can pay cash today, whatever. You can take this home today and it is yours. You have the paperwork,
Yep.
boom. But when I go to buy the same $80,000 house, it's going to take me a month, 6 weeks.
Yes.
And I'm like, you're absolutely right. And so some of that is because of how you get your mortgage, that there's a lot that goes into that. So here we are. A mortgage is the loan specifically that you are going to obtain in order to purchase a home.
Yes. So it's just
It's a home loan.
It's a home loan. The
All
bank. Yeah.
That is what a mortgage is. Did I explain that well enough for a third grader? It's like when you borrow a toy. Okay, so mortgage, home loan. What's next?
So actually, this definition is better.
Oh, okay. Let's
A
hear it.
mortgage is an agreement between you and a lender that allows you to borrow the money to purchase or refinance a home or property, and gives the lender the right to take the property if you fail to repay the money you borrowed.
Okay, so this is another reason why everything takes so long with the home buying proper.
Yes.
With home buying
'Cause if you
contracts. Because we talked about that. I mean, if I buy the $80,000 Tahoe and I have a car loan in order to do so, and I don't make my payment,
They just come get that sucker.
come pick it up. Like I can be sitting at my desk and watching them drive away with my $80,000 Tahoe. But it's not the same with my home.
Nope.
It's a little harder to take my home away.
There's a process. They've got to sue you.
Yeah.
They've got to file judgment. They got to do foreclosure paperwork, sheriff sales, confirm they did everything right. It takes 90 to 120 days.
Is that detailed out in the mortgage?
Yes.
Okay. So I think that's kind of important because like the paperwork involved with a mortgage is completely different than a car loan and it's so substantial and it has so many different caveats to protect you in addition to hold your feet to the fire, right?
Yes.
Okay. What else do you want to talk about? How do banks make money from a mortgage? Like that almost feels like a goofy question, but even whenever I look at the lender fees, whenever we do closing, lender fees are crazy. I was going through some yesterday with a buyer, and we were at about $9,000 in estimated closing fees. And some of those things are like prepaid interest and prepaid insurance and things like that. But when I just look at the numbers for a loan origination fee or for a processing fee or all those kinds of fees, like it's really not that much money.
Not to the bank.
It's really not.
Not on the front end.
So how do they really make their money?
So banks, it's an interest. So they make money on the spread of the interest rate. So they may borrow money at 3% and loan it to you at 7%. So they're making 4% interest. They're making the 4% profit. Now, that doesn't sound like very much money if you just say, hey, 4%. So the concern is then they also have, they have their bank building, their electricity and power and paper and envelopes and stamps and tellers and bankers and all those people they have to pay out of that 4%. So they are a volume game. They loan a whole bunch of money and they make money on the spread. Budgeting in for defaults as well. So on your house, if they're only making a 4% spread, you have the opportunity to make substantially more than that. Because we see people in these other states that the annual appreciation on a home is 10 to 20%.
Right.
So appreciation is the gain. So if you buy a house for $100,000, next year's worth $120,000. The bank only made 4% of that. They made $4,000. You made $20,000. It could also go the opposite.
Helps to lessen, but thinking of it in that respect of this is mine. So if I have the opportunity to increase, I get all the increase.
Right. The
I don't have to share my increase with the bank.
Nope. They just make interest on the spread of the interest. They don't make money on what you do to your house, fix your house.
Right.
So.
But they're also not going to, what you're about to say, they're not going to lower the interest if my house begins to depreciate instead of appreciate.
Right.
Okay, what else did you want to tell me? Because you had this whole list.
Well, I printed a list of definitions as we were kind of going through here to make sure we were clarifying our terms.
Okay, well, I want to talk about this.
Okay.
Where does all the money come from that the banks have that they use to loan me money?
Well, they have this. It's called a Epson printer. No, I'm just kidding. No, that's the Federal Reserve.
Special watermarks.
Yes. So no, the banks get their money. So number one, they get money from people who deposit money in their banks. So if you have a savings account, checking account, CD, any of that stuff where you put your money in the bank can actually loan against that. So that's one, the deposits from the banks.
This is why I just don't keep money in the bank.
Because you don't want to loan money. I bet. Okay. And then the other one is they borrow money from other banks. So you got big banks that make less spread to loan money to smaller banks. And then you have the National Federal Reserve, which is an organization that, money comes from the banks, and then the banks get their money from It's very stupid complicated. I need to break that down.
Complicated, and I don't know how to break it down.
I don't know how to break it down any more than that. But a bank can borrow money from the Federal Reserve, and then they can loan it to you, and they don't. But it's all based on the amount of deposits they have in their bank. So some of the big banks around here might have 50 million in reserves. So they've got 50 million worth of CDs, and then according to that, they have like an insurance policy that says they can loan. Right. 10 times that amount out using this as their kind of their cushion. So banking gets complicated. So, but it comes back to now the banks, they're not making, you think they're making a whole bunch of money. When you make that $1,500 a month payment, that's not all the bank's money.
Right.
So you're paying your principal, which is the principal is the part of the balance that comes off the debt. Mm-hmm. Then you're paying interest, and the bank's making part of that, but they're making payments on that as well because they owe the CD or wherever they got the money. And then you have your taxes and your insurance. So if you break all of that down, like the whole $1,500, people think that's how much money they're making. It's also like rent. It's the same difference. I mean, that's the same difference. It's the same because when you pay your rent, the landlord's not making $1,500. They're making, they pay the rent, they pay the utility. I mean, not utilities, but they make their payment if they have one. Mm-hmm. They make the repairs, the taxes, the insurance. It all splits apart.
Right. I actually think it's easier to see that with your mortgage than it is to see with a landlord.
Absolutely.
Like, I think I'm more likely to err on the side of the landlord is making $1,500 every time I send him a rent payment versus the bank is making $1,500. Because in my mind, I know I'm paying back something I borrowed.
Yes.
But it's hard to understand. It's hard. I think it's harder for people to understand at the beginning of their mortgage because it is stacked. So at the beginning of your mortgage, you're paying way more interest than you're paying principal.
Right.
And then at the end, it flip-flops again.
So yeah, when you buy a mortgage, that's called amortization. Mm-hmm. When you get the amortization chart, it shows you you can print it out. It shows all of your payments, and every payment you make, it shows exactly how much goes to your principal, which is the debt you borrowed, and then how much the interest is, which goes to the bank.
Right.
Every time. And it is way flip-flop. So on a $1,500 a month payment, 500 is taxes and insurance, 1,000 is principal and interest, and out of that, probably 700 is interest and 300 is taxes. Is principal.
Right. And it's, if you look at all 70 pages of the amortization schedule, it'll kind of stress you out a little because you realize that first 15 years or something, you're paying so much interest. Mm-hmm. And then finally, after you've owned your home for some substantial time, then you begin to see, I'm really knocking out my mortgage now. Now I'm doing better.
Now you're making way.
But that's part of the process. It's just the way that it has to be in order to...
Yes.
In order to allow the banks to do the mortgages, in order to allow us to borrow the money to buy our homes, right?
Right.
All right. What were some other things? I think that you had some terms that you wanted to discuss. Like amortization, I think that's a word that we kind of throw around. And that's just, it's just what you said. It's the itemization, basically, of what each payment looks like and how it changes over time. It might be a similar payment for that whole time, but it goes to different things. Right. And then I think some other terms.
Well, the other thing is mortgage. Go ahead.
No, you go.
I was going to tell you, start kind of going through the types of mortgages.
Okay.
So, so there's lots of types of mortgages. So one is more of a flat rate, fixed rate mortgage.
Which is our preference.
Generally. You want to be locked in for 30 years so you can budget around that payment's going to be. Does your payment change? Trick question.
It is a trick question, which I want to talk about that. I'm glad you said that. Okay, so does your payment change?
Your principal and interest.
With a fixed rate, your principal and interest do not change. Your payment can change.
Yes.
We're definitely going to talk about that in a minute. But move on to your next type of mortgage.
Okay, so fixed rate mortgage, that's where your rate is fixed for the term of the note. Next, you got an adjustable rate mortgage. So commercial rate loans are more of this, where they just fluctuate. So I have a line of credit, and it fluctuates with whatever the prime rate is. So if it goes to 10%, I'm paying 10%. If it drops to 5%, I'm paying 5%. So it's whatever the prime is, that's what I'm paying. And the prime rate is based off of, the Federal Reserve kind of sets all those rates, and they change those to it's kind of based on inflation. So right now, the big real estate people and banks are saying, hey, we should see interest rates dropping. But realistically, until they get the inflation rate under control, interest rates will not come down. So I don't know. I don't anticipate. We're still not even to the average. You were saying this earlier, that the national average over the last 30 years is still more than 7.5% today. Whatever the rate was, like 7.6.
You mentioned 7.6 this morning, and just a little, like, just to go back a little bit, because that conversation I think is valuable, even though it's not exactly what we're talking about here. One of our customers and I were texting the other day. It's been a few years since they purchased a home. It'll probably be a few years before they sell it and purchase another one. But she had said, "What about this interest rate? Because it's hard to want to change houses because they got in good. They got in at what, at the 2s or a very low 3." Yep. And I said, I'm going to be real honest. I know that, like, we're hopeful that this year we see some rates going a little bit lower, and I guess it's a possibility. But realistically, that what we saw then was not realistic. What's realistic is the 8s, maybe even 9s. I mean, I don't want to be like negative Nelly. This morning, Brian Buffini was like, there's negative people, there's realism people, and then there's positive people. I really would prefer to be positive, but I want to be real with our people. Like, I'm happy with the 7s right now because it's not 8s.
Right.
That's how I feel.
Yeah. And it's a lot, but it comes back to our society has become a debt-ridden. We live on a shoestring budget.
Right.
We don't live like our parents lived.
No, we do not.
They were very budgeted, very tight. Very tight, very budgeted. They lived inside their means. Credit cards were Satan. Like, it was
my grandparents, particularly, man.
Yeah, I remember when my parents got a credit card. I think I was out. I think I got a credit card maybe before they got a credit card.
Isn't that interesting?
Because it was they didn't have a use for it because of the interest rates, and they budgeted for the stuff. You kind of have to have one to go on vacation now, which we didn't do.
Right. But we need to talk about our senior. Okay. We need to have our little senior session. Yeah. How we talk to seniors. Okay. Moving on.
Adjustable rate is the variable rate. It goes up and down based on the the prime rates. FHA loan is a federal housing administration loan. It's backed by the United States government. So it gives protection to the banks. The banks loan you money. And then they back it. So a bank can take a little more risk because if it fails, the government insures them out of it. And so they have less risk. Then a fixed rate mortgage, which is most FHA, VA, rural development, conventional loans are a fixed rate mortgage.
And government backed.
Yes.
So you can have a mortgage that's not government backed.
Correct.
And then these are government backed.
Right. Okay. That's what FHA is. Fixed rate.
Yes.
You can have a fixed rate mortgage that's not.
I was clarifying because I
bounced quickly. Mm-hmm. So a fixed rate just locks them in for the term, however long your term is. So I have a commercial note. It's a 20-year fixed term note. Mm-hmm. And then like a house is 30-year note. California, they got some 40-year notes, which is interesting. Because why does that work? Well, in California, when they have the appreciation rate is substantially higher than the interest rate, they can go out longer term because the banks can risk more because the house is going to be worth more money. So what's your terms of your mortgage are also based on the risk factor of your loan. I read a really cool language. They said that. I wish I could find it now. Where they said your rate of your But it was they put a number on you as an investor.
Absolutely.
Like, hey, your because of your credit and your income and your stability is worth this much, and it's a score. So you're rated for your mortgage, which is kind of a neat thing. I've never seen it. Would put it that way. It's somewhere in that 40 pages. Then you got VA loans, which are for veterans.
Yes.
Or spouses of veterans. And they are also backed by the government. They've got some benefits inside of that where they're like zero down. Sometimes, our USDA loans sometimes are more beneficial. So we have really great lenders. So even though you're a veteran, sometimes this isn't the best option for you.
Right.
So we want to make sure we get you with a lender that kind of walks through those things.
Because of fees and different types of things that might go into it.
Right.
Yes.
And then jumbo loans. Jumbo loans
We don't see many of these.
We don't. They're like more than 700,000. I don't remember what the rate is now, but they're when you get over a threshold, I think it's 735,000 now. If you get over that rate, they call them jumbo, and they're a little more risky. You have to have more credit, more income to make those happen. And then you go conventional loans. Conventional is a basic loan. That's not backed by like a federal, like the FHA or VA. They're more risk for a lender. The lender has to, conventional are not backed by the government. You can buy private mortgage insurance to cover those. The conventional loan piece are higher risk. I mean, they're not usually high risk because they're lower risk people. So the bank is way more at risk. So that you have to have better credit, make more money. Your score is better. And then we kind of went through the government-backed mortgages.
Unconventional loans.
Yes.
Which is why frequently your interest might be slightly higher on a conventional loan than it would be on an FHA, VA, USDA.
Right. Because
there's more risk on them, so they need to pay for that risk somehow.
Right. It's like private mortgage insurance is like when you get to like 80-20, well, the risk is less. So, because you have 20% equity in your house, if they have to foreclose on you, they can probably walk away, the bank, sell your house and not lose money.
Right.
So that's why between 80 and 100% mortgage, which you can get a 100% mortgage, conventional loan, but you're paying mortgage insurance, which then guarantees back that you're going to pay that. So those are the main things. Balloon mortgages. So these are also a lot of commercial. So I've got one on the building we're in now. It's a balloon mortgage. It's a 5-year note. At the end of 5 years, we have to either pay it off or refinance it. So it kind of gives you the terms of the note to lock you in, so you can kind of budget through the first years. Next is a reverse mortgage. These are really complicated.
We don't see very many of these either. I'll be honest. When I've seen this, is actually on the side when it's foreclosed. Yes. How strange is that?
Yes. And it goes back to the risk factor. So they come back and rate you as a buyer. If what your house is worth, they do an appraisal. They verify how long you're going to live in the house, so how long you should live. They'll use the actuation tables saying you're determined you're going to live to whatever the death clock. You're going to live to 87 years old in 4 months, and so we're going to then they just basically reverse mortgages is they're paying you back your equity, but you're paying interest on as well. So if you have a family member in a reverse mortgage and you're expecting to get the house, be ready to renegotiate the terms of that, pay it off, refinance something, or sell it. So reverse mortgages are a little complicated. If you know somebody getting into one, I want to make sure we don't have a great resource for that, but I will find you one. We have some great lenders that will head us in the right direction. They're not real. I haven't seen any like predatory ones. When they first came out, they kind of were. So I want you to be protected. Rehabilitation loans, these are few and far between, but FHA has one. You can buy a house that needs repairs, and they will finance the repairs. I've only done one in my 20-some years.
I had never seen one until a year or two ago.
Yep.
And a couple agents in our office did one. And I
was like, I
want to watch every minute.
Yep. And
I'd never seen one before.
Still not done.
Oh, my goodness.
It's interesting.
That's terrifying.
Yeah. Assumable mortgages. So if you have a mortgage at 2 and 3% interest or 4% interest, you should read your mortgage. If you have an assumable rate mortgage, I can probably sell your house for more than it's worth.
Just absolutely crazy.
Because of the payment. So, because of 4% on $200,000 is $8,000 a year more. So obviously somebody would pay to save $8,000 a year. They might pay you $5,000 or $6,000. They may pay you $8,000 just to save that.
Right.
And then we have HELOC loans, which isn't even on my list, which is a home equity line of credit. And so you're going to see a massive amount of those coming through because people at these low interest rates don't want to refinance their whole house to put new windows in. So they're just borrowing just enough on a home equity line of credit to put those windows in.
Okay, really quick before we go, we have like 3 minutes left, but I wanted to hit on this, why does your payment change question? Because this is a legit conversation I had with somebody recently about the payment changing. My mortgage payment just changed again. And I realized partly through the conversation that there was a great deal of misunderstanding about escrows, what an escrow really was, why that affects the mortgage, and why it would go up or down. In that case, it was actually going down. So it was like, what? My mortgage went down? How does that happen?
Yeah.
Okay, so why does your payment change? In your payment, you already mentioned all these things. In your payment are principal and interest.
Yep.
Those are not going to change if you have a fixed rate mortgage. Those are going to stay the same. How they are built into the loan is going to change, but you won't feel that change. You'll just know.
Yeah.
Right now at the beginning, I'm paying more interest than I'm paying principal. At the end of my loan, I'm paying more principal, yay, and less interest toward my property. Okay.
You have the
escrows.
taxes, and then tax escrows.
Insurance.
Which also, mortgage insurance is probably not on your list.
Right here,
It is
private
perfect.
mortgage insurance. Thanks. I know.
I want to make sure it's on there.
Okay, so here's what we have. We have your homeowner's insurance, maybe flood insurance as well if you're in a flood zone, your property taxes, and then your private mortgage insurance. So we'll start there because you thought I might forget about it. So many people sell their houses so quick, they don't feel when their mortgage insurance falls off. And if you have FHA or USDA, it won't fall off. Your mortgage insurance is for the life of the loan. So that will be static for you. But if you have a conventional loan, it will fall off. They say 20%, but it's really like 78% is when you actually get to feel.
And you can force that off. All you got to do is have there's a way to do it. We just had a customer do that. They just had an appraisal done. It appraised. And then they remove it.
So, but one of my dear friends, she messaged me one time. She goes, "Hey, Kindra, check this out. I am this close, and I think I'm about to not have to pay mortgage insurance payment anymore." And I'm like, "Girl, call now."
Yeah.
That is stinking exciting and amazing to finally feel that. So that might be $75, $80 a month. It's not like a huge thing, but man, it's nice.
Yes.
Okay, so what we really see making our payments change are your homeowner's insurance and your taxes. So a few weeks ago or a week ago, I don't know, we had Kevin Kansler on the program, and he's my insurance agent, and my insurance increased
28%.
Oh, it hurts so bad. It's like 25% because of a decrease of a particular discount that I had.
Yep.
So that will change my mortgage payment because I have to pay that somehow. So here's what's tricky. If I'm not going to pay, so like they pay that in advance, right?
Right.
And then they also have to be adjusting. So they didn't save enough in my escrow account to pay for that new $500 fee.
Yep.
And then I have to pay it going into next year as well, knowing that it's going to be there.
Catch up and prepay.
So it's, yes, thank you. Those are the right words, catch up and prepay. So that's going to drastically change my payment. So like where my payment may have been $500, maybe now it's $600.
Yeah.
And then next year, whenever I finish paying off that deficit, then maybe it'd only be $550 or whatever.
Yeah.
So, and these are nice low numbers because that's what happens when you buy a tiny little house. That's going to change. Your property, your taxes change every single year. Oh my gosh, it's time to go. I just think that's really valuable. If you don't understand, please call us. We can sit down and show you.
We'd love to.
Okay, that's it.
Yep. Hey, it's the Brian and Kindra Show. I'm Brian Cook, 580-334-2303.
Kindra Brown, 580-216-0090.
All right, listen next time.
See you later.